Welcome to another edition of Focus on Alternatives, a partnership educational series between Real Assets Advisor and ADISA. Today I have Angus Baker, CIO with Montego Capital Partners. Thank you for joining me today. Today we're going to be covering 1031 exchanges into royalty programs. So first off, why do investors use royalty programs for a 1031 exchange?
Well, regardless of whether someone is doing a 1031 real estate to real estate or real estate to oil and gas, typically the motivation is 100% a deferral of tax dollars. 1031s have been around for a long time. The tax code 1031 states that if you have something, that you own something as an investment property, and upon a sale of that property, and you're faced with looking down the barrel of Uncle Sam's gun, then you have the option to take those gains and replace them in something that is like kind.
So by using 1031 exchange, we can add a lot of value to clients by saving them money with taxes. Can you outline for me how this works for oil and gas royalties?
Typically, people, for many, many years, people went from oil and gas to oil and gas and from real estate to real estate. However, it wasn't until the early 2000s that someone wrote an opinion, a tax opinion, on going from real estate to oil and gas. The reason it qualifies is because by the IRS's definition of royalties and minerals, you own non-possessory real estate, not surface, but subsurface, which is where the mineral and royalties would eventually come from the production of oil and gas. So what you actually really do own is real estate.
Interesting. So how do the royalties qualify for 1031?
For exactly that reason, is that they are deeded, they are titled. In our offerings, we will have 10, 20, 30, 40, 50 investors. They all have an undivided interest in the property that we are offering, and they each have their own title, independent of all the other investors. So, and that is recorded at the county level and is a public record.
Okay, great. That makes a lot of sense, but all investing has risks. What are the key risks that we should be focused in if you're doing this type of transaction?
The risk of minerals and royalties are maybe unlike any other investment that you have a chance to invest in. The risk are production and price. Minerals and royalties might be one of the only investments that what I call eliminates the left side of a balance sheet. There are no future expenses burdened by royalty and mineral owners once the investment is made. It's very unusual to have an investment paid off of gross instead of net, and royalties and minerals are paid off the gross.
Interesting. So you also mentioned just a minute ago that most people go royalties to royalties or real estate to real estate. What are the key differences between a royalties 1031 versus the brick and mortar real estate?
Well, I kind of touched on that in the last question. The bricks and mortar real estate, think about the average person who owns bricks and mortar real estate. They do it for an investment purpose. They typically buy a property. They typically pay that property down. They use it as a rental property, so they're collecting revenue. In between the revenue that they collect and there becomes an expense that they have to pay. I think in real estate they call it the 3 T's, tenants, toilets, and taxes. After the end of those expenses, what's left becomes a net profit. However, in royalties, we don't. We get a royalty or mineral interest off of the production of oil and gas coming from the acreage or subsurface that we own, and the burden of cost, whether it's drilling a new well or whether it is operating wells that have already been drilled, the burden falls on the side of the working interest. So once an investor makes an investment into oil and gas minerals, that's the last check they write. From that point forward, the cash flow is one way back to them for the life of the property.
That makes a lot of sense. So can you give us a few examples that you've seen of how investors are leveraging this type of 1031 transaction?
Absolutely. What comes to mind, not only is it personal in my own family, but what comes to mind is back in 2005 when we first introduced this concept of going bricks and mortar to oil and gas. We saw hundreds of millions of dollars coming from the West Coast, where people were selling real estate that they, believe it or not, that they had owned since the 1970s. And they might have paid $20,000 or $25,000 for that real estate, and they were selling it for $2 million. And that's how much it had appreciated over the 40-year period. So think about the tax liability on that gain, knowing that you had probably written the property down to a cost basis of zero, and you're now looking at $1.8 million worth of tax liability. So the motivation at that point is pay the tax or find a replacement property in which I want to defer the tax. So I could go back into real estate and I could keep managing the property, but once they heard that the management of the property ceases in minerals and royalties and the expense side ceases at that point, people flocked to oil and gas royalties for their 1031 needs.
Interesting. So can you kind of build on that a little bit more? What is the typical investor profile that would be drawn to this type of investment, or what is that typical portfolio that would be most suited for this?
Well, I think there's two. I think you'll go back to the original question. I think the motivation of anybody using the 1031 code, the motivation is a tax liability. However, I think we see closely behind that typical investor folks who are, I would guess it would be your baby boomers nowadays that are approaching retirement. They have made their wealth. They have positioned it nicely with the hopes and fears that they don't outlive what they've saved. When they use minerals and royalties in that case, they substitute the income coming from the real estate and don't necessarily have to dip into the principal. So we call those people heading for wealth preservation, not wealth creation. So we see a lot of people in our business that are approaching retirement and using royalty and minerals to try to subsidize the lifestyle that they have while they work after their working career is over.
Makes a lot of sense. We're all trying to develop multiple income streams. So Angus, thank you for walking us through 1031 exchanges and how to do that with royalties.
You're very welcome.
And thank you for watching another episode of Focus on Alternatives. For more information about 1031 exchanges and oil and gas royalties, visit adisa.org or realassets.advisor.com. Thank you.